Hi guys, thanks for joining us again on another episode of Off the Sidelines Property Podcast. We have an amazing guest with us today, the esteemed Lepeye Oyekanmi, joining us from GTM Finance. And I'll get Lepeye to introduce himself and tell us a bit about what he does.
Fantastic. Nice. Thanks for inviting me, Dan and Onis. Good seeing you guys here in Sydney. Obviously, I'm based in Melbourne. So I'm what you call a holistic financial advisor. I assist clients with their financial planning needs and helping them secure their financial situation for things like retirement.
Yep.
And also look at the risk at the same time. So four main services that I'm helping my clients out with is personal insurances, which covers your life insurance, income protection, total permanent disability, trauma cover. Secondly, superannuation advice. So that ticks on you've got three main major types of super funds. There's a couple more, but the three major ones are your retail funds, your industry funds, which is your Host Plus, your Australia Super, likewise, and self-managed super funds. So looking at things like the fees, the performance, the asset allocation, what you invested in, and also particular things for the client situation. Thirdly, I help clients with the investment advice. So goals-based advisor, which essentially means understand what the client's financial goals is and then curtail those recommendations to what they're looking to achieve with investments. And well, of course, that's all around the framework of risk profiling. So understanding the client's risk versus reward. The lower the risk, the lower the reward, the higher the risk, the higher the reward, and also time horizon, right? On how long the client needs is able to stay in an investment before they need to, let's say, liquidate or access the capital. And fourthly, I also assist with cash flow modeling and projections and things like that. So seeing how people are actually tracking along with their current situation for, let's say, 15, 20 years to retirement, etc. And then making other scenarios to see if they can then reach their goal if, let's say, they're having a shortfall or they're not reaching that goal. So those are the fundamental core portions of advice. Is obviously Centrelink planning, aged care planning, other portions in advice as well. And it all kind of overlaps with the accounting, the broking side of things, the estate planning, solicitor. So we assist with kind of project managing or assisting clients and introducing them to people who can help them with those other specific parts that kind of overlap.
Yeah, wow. Now, that's a pretty in-depth overview there, Lepeye. So thanks very much for that. That was great. What I want to understand is, when do people come to you? So do they come to you before they're thinking about investing, after it? What kind of scenarios would people typically come and say, hey, look, I need a bit of advice, or I need a bit of help, or I just need a second pair of eyes to just glance over this deal that I've got going on?
Yeah, good question. I would say correct. There'll be some specific life events that have happened. So they've just had a child and they'll say, okay, I have more responsibility. I need to have a review of my insurances. That's a trigger point. I've just bought a home. I should probably make sure it's insured correctly. I'm now going to have some disposable income after my mortgage. What do I do with that? I've got married. We've now got two incomes coming in as opposed to one. How do we structure things? How do we look at things like that? So usually all of these are trigger points for the most part. However, I would say that usually for the most part, it's beneficial as soon as somebody's started working, as soon as they've got their full-time job, there's things that can be looked at. One thing that might not be as well known or I guess projected out there is that there's what we call scoped advice. So if a client might only be able to look at one thing right now because that's all that's relevant, it's still better to do that as opposed to waiting, a long time down the road. Say, okay, I want to make sure I've got this much income and this much things before I see an advisor, because they can get to other goalposts probably sooner by them engaging in that advice as opposed to waiting till too long down the track.
Yeah. And I know that some people, and before I became a buyer's agent, I was like, look, these professional service providers, they're a bit fancy for me. And you get that mindset that you're just going to fork out a lot of money for advice or any kind of consultation. So what's your advice there to people that, you know, that are probably in the work field and they've started their first job? Should they, you know, regardless of how much it's going to cost, still seek such advice, or what's your approach?
Yeah, that's a good question, and it's always coming up, the value of advice, right? I think the FPA and a few other organizations have done some surveys asking on the value of advice, and a lot of people have stated that they only want to pay $500. Like, that's the average amount that they wanted to pay, which the cost to produce advice is substantially higher than that, right, for us to be able to run a business. But at the same time, the amount of value that we add, obviously I might be a bit biased, I will certainly say is worthwhile. I always kind of compare ourselves to, let's say, an accountant. If a client has a accountant that is doing their structures with, whether that's a trust or a company, I've spoken to a lot of accountants, and it's rare to find them charging less than $1,000 for individual entities, right? And that's on a year-to-year basis just for the compliance. Accountants are usually looking at your today and in the past, like doing your reconciliation, doing the returns for the previous year, etc. Advisors usually forward looking as far as forecasting, setting things up, advising on what they should do later on, right? So due to the fact of all these different strategies we're looking at, whether that's increase in alpha from your returns from your investments, or other strategies and introducing them to accountants or whatnot, on giving them tax strategies on reducing the tax they're paying, a lot of the time, even if it's not giving them a lot more than what they paid for the fees in the first year, usually within a short period of time, they are in the benefit and getting more benefit from what they paid than what they initially paid in the first place. The other way to put it is tell other clients, I'm not in the business of costing them money. So essentially the alpha or the savings they're going to get from, you know, increasing investments or whatnot is usually a lot greater than what they paid in the first place. So yes, it's the challenge advisors have, because it's long-term planning, right? They're not going to see the results in the next two months, 6 months, but they over time they will, and certainly it usually shows that it's better from.
I'll let you chime in here, Daniel, but just a quick one from me. I like that analogy you use. Accountants are in the past, advisors, financial planners are in the future, and I've never heard anyone speak of it that way, because like we use accountants all the time, and it's usually to get us out of trouble. Well, I guess for me personally, for our tax affairs in the past, but then looking forward, where I want to, you know, go to, financial planners are great to help you kind of, you know, keep you on point. So I really do like that analogy there. So
no problem.
I know Daniel's bubbling with questions, so I'll let him do his thing.
No, not at all. I'm loving the wisdom from you both, and just sitting there and listening and enjoying the feedback. Couple of questions I've got from an SMSF standpoint of view. It's a big buzzword that's coming out at the moment the last few years. I feel like a lot of people didn't even know that, and especially where I come from the country, like a lot of people didn't even know an SMSF existed. As far as they were concerned, they would just work, they would get their money, that was their money they spent. And then when they retire, they may have 100 or 200 grand left over from their super, and that's meant to last them for quite a long period of time. But now people are starting to realize, well, hey, I can actually do something myself. I don't have to wait for the government or wait for the economy or wait for someone to invest my money for me.
Yep.
So in what's the basic step if people wanted to look into getting an SMSF? How would they go about it? Who do they contact? Do they contact you first? Do they contact their accountant? Obviously, don't get them to look at someone like the Barefoot Investor or something per se, but who would they contact instead of Google or something like that? What do you think their steps should be to work out if that might be something for them?
Yeah, absolutely. Great question. Again, they could go to the accountant to kind of get some basic understanding as far as how an SMSF works and the obligations. However, accountants, unless they are duly licensed as a financial advisor as well, cannot provide advice.
Yep.
They can establish a self-managed super fund, but again, without them being an advisor, they can advise their clients to establish one. So the gatekeepers now are financial advisors who will look through a client's current circumstance and situation, and kind of confirm that it is in their best interest to have a self-managed super fund. All right. That was your main question, right? Like who they should go to first, right?
So example, like from a customer's perspective, they can reach out to an FP and have like a consultation, and then you or another financial planner within, I guess, the first call can identify if it's something they may be able to look at or something like that. Is that usually?
Absolutely. So like you mentioned, it is kind of a buzzword. So when a prospective client does talk to me about SMSF, my very first question back to them is, why are they looking at SMSF, or what's their understanding of SMSF?
Not just the buzzword SMSF.
Exactly.
Yeah.
I would try and understand what it is within SMSF that they're looking to achieve, that they cannot achieve, that they believe they cannot achieve with an industry fund or a retail fund. Because I've heard a lot of clients say that, I want to be able to buy shares, right? Direct shares, because I cannot, they believe they cannot buy the shares with their super fund. Industry funds, I won't need to name any of the specific ones, but some of them now do let their clients purchase A300, so top 300 shares on the ASX. And then retail funds, you certainly can buy all shares in the ASX and even international. So therefore, if that's the sole reason why they wanted to open up an SMSF, they're now doing too much, right? Though there's a lot more involved. So to give a high level overview in the requirements with self-managed super funds, you're either setting it up as an individual trustee or a corporate trustee, which is essentially a company and a trust as well. And therefore, it does need to have the yearly tax return, right, for the investments in there. It has to have a yearly audit. There's the additional company fees. There's the ASIC fees. There's ASIC levies, I should say. So with all these additional requirements and note-taking and things like that, the client will have to be well more involved with the SMSF than they would if they were in a retail or an industry fund. Right? So again, if it's something as simple as just buying into shares, that's overkill, and it may not be in the best interest of the client. So I'll definitely understand the situation and then assess that and then say if it's relevant or not. Usually it's business owners and things like that, or people who do have specific things they're trying to do. For example, direct property, you need a or commercial property, you need a self-managed super fund to do that, to own those. And if that's the situation and it makes sense for the client after doing all the due diligence, the risk profiling, the fact finds, etc., then that would be, a scenario situation when it would make more sense.
Yeah. And typically with SMSFs, what are the perks that people kind of are attracted to?
It's a good question. I would say, I can give you 3 examples or 3 different factors with the SMSF versus a retail industry fund. You can have direct property, I mentioned. Secondly, you can buy things like artwork, and you can buy classic cars, you can buy wine, you can buy all these other things that obviously awesome. You can't use any of it, right? There's arm's length agreement, sole purpose test, meaning you can't touch it till retirement, but these things obviously you wouldn't get with another super fund. Or thirdly, things like businesses, that there is a business exception rule that people are able to use their business premises, or if they purchase an asset within their super or anyway SMSF that's for business use, they can use that, which therefore they wouldn't be obviously allowed to do outside of SMSF. And if they purchase it with their own funds, they might not have the cash flow or something, so it kind of can get them to there. So those are the main things of what I've come across and why they use them. And it's also control. I would say most places I've researched and spoke to other people is having that control, right? There's obviously more work to have that control, but at the end of the day, you still have more control than the other sites, other types of supers.
And that's a really good point. I think like us more as individuals, the more we get educated on finance and how to become wealthy or retire with cash flow positive sorts of assets, a lot of us didn't get taught that at school or taught that from families. So that's where the SMSF model was, just a set and forget. But now with like education courses and people becoming more aware of their assets and their journey, I think it's becoming a lot more popular and a lot smarter for people to look into that and get the education and find the time to be able to do that sort of stuff and understand what they can achieve if they do monitor things themselves, instead of just waiting 30 or 40 years and going, hey, I've got 2 years of super now I can have fun for, now I'm retired, then I've got to go back to the dole or something like that. So it's pretty crazy times to think that we can manage things like that ourselves, or even have the opportunity to look into that.
Yeah, absolutely.
And Lepea, I want to talk to you about trust. I think these are buzzwords that, you know, if a few people throw around. What is a trust, and when is it a good time to set one up?
Sure.
I hope that's not too broad for you, but yeah, if you can dumb that down for us, you know, being a financial planner, then I think we can take it from there. Yeah.
Yeah, so I don't set up trust myself. Some advisors I know do, but usually sits in the realm of accountants' duties. From my understanding, there's two main trusts of unitized trust and family trust. And again, depending on what the client's looking to do, is why they'll consider a trust. Trusts don't, so for unitized trust, for example, different people own their amounts of units in it. So that's usually the one that you'll set up if it's with friends or whatnot. And let's say you had 120 units in the trust. If we all have 40 units, then that's how we have equal partnerships within that setup. With a family trust, you'll have your assets that you're purchasing within the family, and then you have more flexibility in the way that things are moved around in there. So those are the main two reasons. And I guess your questions on, let's say, why someone might want to look at that is because, of course, there's different treatment of it, as opposed to it just being in your own name versus in a trust when you have different income levels and things like that.
For sure. And just regarding that, I guess there's an element of asset protection also with that. Would you advise for trust or against trust, or that's not a part of your scope?
Yeah, for that, it's all very circumstantial based, and a lot of the time there has been scenarios of some of the trust issues or trust scenarios that would go over to a legal aspect, speak with a lawyer, and then the lawyer might be able to understand, and then they will still have some implications or issues that go back to the accounting. So, it's definitely very fluid in regards to what's going on. Just for example, you've got your things like your testamentary trust, which is part of estate planning, and then there's tax implications, and obviously it's a testamentary trust from a lawyer, so there's the legal implications as well. So certainly having a group of professionals hashing out what that family or individual is going through will help determine if it's in essence the best scenario for them. So that's why advisors, knowing the client's whole journey or what they're looking to achieve, will be able to explain that. I think I've mentioned previously in our previous conversations, what's relevant or best for a client now may change and evolve in 10 years and also change again in 20 years, because their income's going to change, their family situation is going to change, their assets are going to change, etc. So there's no one size fits all for not even just two individuals, but even that same individual, right? Because things change. So that's why it's very important having those right professionals around you, right? So that they can then be advising you as time goes on what is most optimized for their situation at that point in time.
In relation to SMSF purchasing, out of curiosity, if let's say I've got $50,000 myself and I get along well with my three brothers and they also have $50,000, could we go in together and get an SMSF fund and accumulate that money and buy together? Would that be a benefit that we would be able to look into?
So yeah, SMSFs, I think they increased the member balance director trustee numbers to 6 from the initial 4.
Okay.
Do have to be immediate family members.
Yep.
However, again, it would be possible, but if it's actually the best situation or not is another scenario. Some things I've come across is when if, let's say, property was bought and let's say a member passed away and the beneficiaries, of course, are not the other brothers that might be children, what's going to happen is those other three brothers will need to come up with the funds to cover the equity of that member that passed away, right? And if they don't, that's of course going to get a lot of issues from a liquidity standpoint, etc. So they have to have all these contingencies in regards to that, the right amounts of insurance, etc. So there's a lot of different things that need to be considered before, people should just jump into that. So it is possible, but again, all the individual circumstances, all of these risk circumstances would be reviewed and considered before taking the step forward for that, something like that.
Yeah, so to summarize that, you would need to speak to a financial advisor to clarify if that is the right strategy, not just set up an SMSF and go out like a cowboy and go and buy a property with you.
There's a lot more steps involved before people can get to that, but correct. Yeah.
Absolutely. But that's good. At least people can think, well, hey, that is an option. I can have a chat with someone about it. Or even if it's, your mum or your dad or something like that, also they can look into that instead of thinking, well, it's going to take me another 10 years to get that super up and things like that. That could be an option. Or you might even have a different strategy for them, per se.
Yep.
And Lepay, I want to talk to you about insurances. It's a necessary evil. It has saved me in many situations, but it has been, my demise in terms of cash flow in a lot of situations. So what kind of insurances do you deal with? And how do you best position prospective clients for insurance?
Yeah, great question. And I always usually cover off insurance first when I'm, onboarding or getting to know a client. It's a lot of people find it the most boring part of advice, but I believe it's just as important as everything else. We all ourselves are our most important asset and our ability to create an income. Right. So therefore, having the right amount of insurances behind you is very, very important in people's strategy on getting to their financial independence or their financial goals. The four major types of personal insurances is life insurance, total permanent disability cover, income protection and trauma cover. These insurances can be held in three different areas or we'll call them areas or types of areas, in the sense that you can hold them in your super, which is called group cover. If it's owned by a direct company like NIB or Allianz or those companies that have health insurance and let's say car insurances, those are called direct cover. And then the third one that financial advisors usually offer is called your retail cover.
Retail cover. So group cover, direct cover.
And retail cover.
Retail cover, okay.
So the main differences between the three is direct and group insurance have very limited underwriting. So underwriting is the medical information they'll find out before giving a policy. Retail covers usually goes through a full underwriting situation. Or underwriting reports where they will actually go through your details to make sure that they understand the health of the client, because insurance in general is all about risk. And with the retail covers, by them doing that more comprehensive understanding of that client, they will then save themselves from having somebody who's too risky that has a high chance of claiming, right? Or they'll adjust accordingly by giving that individual more loading, so increasing the premiums they would pay. For example, most insurers have a 50 to 100% loading on smoking. If they smoke, they're like, this person's higher risk for most issues, so we're going to double their premiums, right? Or have exclusions. If they've already injured some part of their body, the chance of them injuring that is most likely going to be higher, of course, so they'll say that part's excluded. So being able to modify all of these different types of covers or these policies, they're able to moderate the risk and then keep the group of the premiums lower than higher, right? Because at the end of the day, whenever claims are had, that's taken out of the group of the premiums that were paid from the individuals who have the policies, and that's what's going to be increasing the policies, right? So that's a bit of understanding in regards to the structuring of the differences between the direct, the group, and the retail. And then in the regards to the individual covers, life cover obviously covers you, self-explanatory, if you pass away, and also terminal illness covers you for that too. Total permanent disability covers you if you're totally permanently disabled and unable to work again. There's two different definitions. You have your own occupation and any occupation. So superannuation funds can only cover you for any occupation, which means you're unlikely to work in any occupation that you have experience, training, and education in, whereas own occupation is more specific. And if you cannot work in your own occupation, then you meet the definition to claim. The easiest way I explain this to clients is if, let's say, you're a surgeon and you have you're a surgeon, you get MS, multiple sclerosis, which means you're going to lose ability in your hands to be steady to obviously operate. That individual, under any occupation definition, may still be able to lecture because that's part of their education training experience. So they may have a harder time claiming that policy, getting whatever they're sum insured for because of their any occupation. But if their own occupation and he cannot work as a surgeon anymore, he's met the definition of claim. All right, so that's one of the niche differences for total permanent disability. So life, total permanent disability, lump sum payments, so they'll pay once off. Trauma cover, that covers you for your things like heart attack, cancer, stroke, diabetes, extreme illnesses. Usually the insurers have around 30 to 40 illnesses that are covered. And then the fourth type of cover, my favorite one, personal favorite one, is income protection. And income protection covers you for up to 70%. It was 75% up to October 2021. Now it's 70% of your income if you can't work due to sickness or injury. So that one is a monthly annuity, a monthly benefit. And you can be paid for up to 2 years, for up to 5 years, or to the age of 65. All right. So I always use the example, that one's more expensive than the others because it's the one that's claimed the most as well. So I like giving the example of, let's say, an individual's earning $100,000. All right. Scenario A, and they don't have income protection. So if something was to happen to them in their career of their working career, their income will go from 100 to 0 essentially if they're not able to work anymore after their benefits of sick leave is used up, versus scenario B of somebody who has an income protection policy and let's say they're paying $2,000 a year, 2%. That's just an average, could be higher, could be lower, just using that as an example. So they're going to be having $98,000, right? Because they're paying $2,000 a year. If something happened to them in, let's say, year 2 to year 10 or whatever they have the policy, their income drops from 98K down to 70K because they're insured for 70% of their income. So to my understanding or my opinion, that person who's gone from 98K down to 70, if something happens to them, yes, they've got to tighten the belt some more. They might not be able to go on as many holidays, but as far as where they live, their kids' schooling, etc., their lifestyle should not be affected too dramatically, right? And keeping on to their claim, if they don't claim, having 98,000 also is not going to change their lifestyle too much from 100 to 98. But scenario A, if they went from 100 to 0, of course, now their whole life is turned upside down, right? So certainly having that risk mitigation on having that backup plan in case of something happens is extremely important. And again, everyone has car insurance, but at the end of the day, if your car is totaled, you can get another car. Most people will be able to, even if they can't pay for it in cash, they'll get a loan to get another one. But we all have car insurance. It's a requirement from the bank to get home insurance as well, right? If there's a natural disaster or a fire or something like that. And at the same time, that's obviously going to protect the asset of the house and not yourself. So I just kind of personally think that it's very interesting how those other two things, which are not as important as ourselves, are covered by pretty much everyone, but then not everyone has that
Why
personal
is that?
insurances.
Why do you think that is? Why do people overlook income protection insurance?
Or the other insurances.
Yeah.
I'll say there's a few reasons. One's the education, of course. Like, I'm not sure how much you both of you knew about those covers that I just covered and how it works, but education push.
We've got them all, don't we, Dan?
We do not No, full disclaimer, I will not be talking about our insurances on a podcast.
No worries, mate.
So, but yeah, get it. Like on an average, 10 people, if I'm speaking to them, maybe two might have, or they'll think that they're just covered in within their super.
Yeah.
And of course, the super, what's they're provided is a default amount, which certainly 9 times out of 10 is not going to be enough or sufficient for the client situation, right? So that's one reason why they don't know about it. Another 2 reasons why a lot of people don't have cover is, one, they think that insurance companies don't pay out. We always hear that a lot too.
Yeah, like the Panama Papers and all these, shell companies and whatnot. Yeah.
Oh, well, that's more, I think the Panama Papers, etc., is more on taxation, not as much on the insurance.
Not so much insurance.
Insurance, a bit of a different topic there on this.
2 birds, one stone, mate. Yeah.
But essentially, things like those pre-existing exclusions. Somebody had already broken their arm previously. They didn't disclose they had a broken arm. Then they break their arm later on. Yep. Call the insurer, says, "Hey, I want to claim on income protection. I broke my arm. Sorry, you had a pre-existing condition of a broken arm," because usually insurers don't cover pre-existing conditions. So that's why I said it's very important, or it's a good aspect of retail cover doing that that underwriting at the application. So therefore, there's no question marks at time of claim. Whereas if they're only looking at their medical information like through group cover at time of claim, there's more question marks and more ambiguity on if they're going to receive the claim or not, right? So it's that understanding they think that they're not going to pay out because they don't understand the policy they may have, right? And secondly, the I'll be right type of mentality on, I'm fit as a fiddle, nothing's going to happen to me. I check my health, I go to the doctor, I'm at the gym 5 days a week, but you
do ice baths and all that kind of stuff.
But, but unfortunately, you don't know who's driving on the other side of the street as you, right?
True,
you don't know all of these genetic factors that may come up in your lifetime later on, etc. So just, again, at the end of the day, you can take the risk, you're gambling. When you're having insurance, essentially what you're doing is you're transferring that risk to somebody else, because there is a risk there. The risk might be lower for somebody than somebody else, and it might be higher, but there is still that risk there. And if something happens to you, instead of you covering it yourself, you transfer that risk to the insurer. So even high net worth individuals who could cover themselves, not need and be fine financially now till retirement age anyway due to their assets, a lot of them still might have that cover, because instead of them drawing down hundreds of thousands of their own assets, they're having the insurer pay for it, right? So, and then some people can use that in regards to estate planning and other things like that too. So definitely there's those pros on why people should look at it, and again on why people don't have it, because they have those misconceptions. But certainly for the most part it's more positive than negative on having the
It's funny that you say that, because I bet you that a lot of those people would probably put a few $100s through the pokies each month and not think about it and lose that quite comfortably, but they wouldn't think about protecting their health for the future and things like that. It's an interesting topic, isn't it? The way that we think about those sorts of things.
Yeah, no, absolutely. And one thing also I was going to note is I mentioned how group cover within super is obviously not as comprehensive as the retail cover. You still can have superannuation as an option on structuring, having the superannuation pay for the retail cover, right? So the super fund is kind of doing rollovers to pay for the retail cover. However, it's still structured under the SIS Act. So that's like the Rules Superannuation Insurance Act on the still the same rules on releasing the benefits and things like that. However, there's hybrid ways of still paying for portions of the policies outside and inside, where you still then get the full options and definitions in the policies. So didn't want to get too complicated in that, but essentially what I'm trying to say is that there's other ways to cover the costs of the policies and still get the comprehensive benefits of having a retail versus just super covers.
Right, okay.
Makes sense, yeah. Absolutely. And have you got any more questions, Onus? I think we're at the end.
Yeah, we're at the end of such a great segment with Lepeye. I guess, Lepeye, I want to get any passing comments from you, any quotes you live by, any one-liners or philosophies that you can share to those that are kind of embarking on this wealth creation journey, and share your experience and how people can, I guess, better themselves, and you know, how they can be open-minded to, you know, asking questions and seeking advice, seeking help?
Absolutely. So there's a few, I guess, philosophies that I kind of attribute to or have affinity to. I'm sure you've all heard of the you lose 100% of the shots you don't take. All right.
Ooh, like it.
Boom, fire.
Right. So definitely just keep on. You trying something is better than not trying anything at all. Also, I would say that we have locus of control. So believing we're going to achieve something is halfway there on getting there, as opposed to not having that confidence. So that confidence and belief is a big portion of things as well. I've also read a book recently, Outliers by Malcolm Gladwell. Excellent book. Recommend you guys reading it. Yep. And he basically talks on a few topics and points in there, as far as one, having that unfair advantage. So examples, people like Bill Gates, when he was creating Microsoft back in the day, he had so much more time on practicing coding, when not a lot of people, it was very expensive to code in the 70s. So by him having that unfair advantage of getting so many more hours because of the network he had over there, he was able to really run with that. So that's one thing on being able to really double down on your niche or whatnot, or what you're in that maybe other people's might not have the same access to. And also the staying in things for a long period of time, seeing them through, right? So you've all heard the saying that it takes 10,000 hours to be an expert. The quicker you get to that 10,000 hours, the probably higher chance and probability of you exceeding or being that 1% or being better than the others in that, right? Because we all have that mentality of thinking the grass is greener on the other side, but what we're doing essentially is starting back at zero each time you're resetting and switching to something else. But if you're staying with what you have, people, for example, Warren Buffett, he attained 95% of his wealth after the age of 55, right? So it was just staying true to what you believe and working hard. I believe people can be successful in whatever they do if they just stick with it. So that's why you always hear people saying, do what you like and feel like you're not working, as opposed to just doing anything else. Because when you're doing what you like, you wouldn't have any issues on continuing doing that for a long period of time.
Sure.
And then, you'll have that expertise and things will just work exponentially, as opposed to getting bored and switching to something else and starting over again. So yeah, all of those things kind of blend together in regards to sticking to one thing, working hard, and believing you can do it, pay off.
Beautiful. What about you, Onus? You got any words of wisdom or buzzwords for the week? I think your main focus this week is energy, focus, clarity, if I'm correct.
Energy, focus, clarity, yeah, mate. That's where I'm at after doing a few ice baths earlier this week. So I'm on the Wim Hof ice bath kind of trend right now. So I'm rocking with that. So yeah, how about you, Daniel?
Nah, I think energy, focus, clarity is what I'm working with as well. The one vision, the one goal. So I'll stick with that.
Beautiful. All right, we'll wrap it up. And
thanks again, Lepaya, for coming on.
Legend, thanks for your time, mate.
Appreciate you coming from Mexico to get here, the south, big Melbourne. Thank you very much.
Yeah, well,
appreciate it.
They let us through the borders this time, so
there was no wall. You're right.
Fantastic.
Awesome.
Cheers,
all right,
guys.
legend.
All right, thanks.
Appreciate the pay.
Thanks, guys.
Hey guys, this is Onus.
And Dan here.
Thank you very much for listening to our podcast.
If you guys like the podcast, smash the like and subscribe button.
And we look forward to having you back on our next episode.
And if you have any questions for us or our guests, please comment below.
Or send us an email to info@windowpropertygroup.com, and also slide in our DMs on Instagram, TikTok, and LinkedIn.